Led by increased consumer spending and stronger net exports, the U.S. gross domestic product growth rose in the fourth quarter of 2011, possibly at a rate that indicates economic recovery is picking up speed. Now, as we wade knee-deep into 2012, further positive economic developments would be welcomed by insurers that endured a difficult 2011. We sat down with AM Best Senior Managing Economist Jim Gillard and economist Nancy Snyder to discuss, among other topics, what uncertainties and challenges remain, as explored in AM Best's latest special report on this topic.
Certainly 2011 was a challenging year. Growth came in way under expectations. In large part, there were transient effects that kind of slowed the economy down, such as the tsunami in Japan and the uprisings in the Middle East, North Africa region.
Right now, our expectations are that GDP will grow about 2.3% in 2012, up from 1.7% last year, and to continue actually to 2.9% into 2013. With that economic growth, we also expect a slight decrease in the unemployment rate. Recently, we got some very positive employment news that hiring seems to be heading the right direction. We'll see how long it takes to really bring that rate down.
Looking how we expect somewhat positive. Consumers will start to spend a little bit more. We expect housing to kind of bottom out, and business investment should pick up, kind of moving the economy forward.
With assets in the trillions, insurance companies are a very large part of the investment community. And their portfolios, which are feeling the strain of record low interest rates, appear to be facing those significant headwinds for some time.
Well, we expect interest rates to remain low for at least another 2 years. In fact, the Federal Reserve last month came out and stated that economic conditions will likely warrant extremely low interest rates for at least late 2014. We expect the Fed to follow through with this, and that would mean insurers will be facing near 0% short-term interest rates for 6 years. So the low interest rate environment should be here for the foreseeable future.
Insurers staring at the prospect of lower investment income may decide to find creative ways to operate. Some may choose to increase allocations to risky assets to mitigate low interest rate risk.
Certainly some insurers may look to increase their yield, possibly by going into equities more or trying to find higher yielding corporate bonds or other bonds. But in general, insurers are fairly risk averse, and they have sort of an eye towards long-term stability.
By the Fed projecting interest rates this far into the future, it should give insurance companies a better opportunity to plan and make adjustments to their interest-sensitive products.
Indications are that the economy is headed on the right track. One major stumbling block may be the situation that continues to unfold in the Eurozone as the debt crisis spreads from Greece to Italy and shaking the markets here in the U.S.
We think the biggest threat to the U.S. outlook, the biggest risk in the next year or two, is certainly the European sovereign debt crisis. Currently, the European debt crisis is creating volatility in our financial markets. It's also reducing exports. This is having a slight drag on growth. Our baseline forecast is for Europe to continue in this muddle-through process, kind of slowly moving towards a fiscal union and those kind of things, which should just kind of dampen economic growth.
However, there is some risk that there could be a disorderly default in Greece or one of the other peripheral countries in the Eurozone, and that could possibly lead to a pretty severe recession in Europe, and it could push the U.S. back towards recession. But we don't expect that to happen moving forward.
You can find the full report online at ambest.com.